Okay, awesome. I think I can meet your guys' expectations today. Um, but yeah, let me know once you guys see the presentation on screen right now. Looks good. Sweet. We're going to go ahead and dive right in. So this is day 2 of DeFi Horizon Summit. We're going to be doing a live portfolio masterclass. So we're actually going to be building out the portfolio today, a $50,000 portfolio. I'm going to be showing you exactly what I would be doing if I were in the shoes of investing into a portfolio out of this size. So it's going to be everything tailored to my risk tolerance and where I'm personally at in my journey. Now, I do want to quickly say, this is not an opportunity for you to just come in here, see what I do, and then instantly copy it. Why? Because within 2 weeks, you are going to need new ranges. Within 2 weeks, you might even need new pools. When you start to see swings for assets, well, of course, you might not be able to stomach them. And the simple reason why is because they are not tailored to you. So I want you guys to pay very, very close attention to the how and the why I'm doing what I'm doing in the tutorial, as opposed to just what I'm doing, if that makes sense, right? Yesterday, we broke down the entire DeFi formula process, start to finish. A lot of you guys provided some very, very great feedback. I got a lot of messages saying that that's the most they ever seen. I got some people even saying they went to a paid event, a couple weeks ago or so, and they got more value here today for free, live on YouTube, from the comfort of their own home, without having to spend thousands of dollars on a ticket to go to an event. So again, great feedback from you guys. I'm glad I was able to meet your expectations today, and hopefully I will be able to meet them again today. So with that being said, we're going to be doing a $50,000 deployment workshop. We're going to walk through how you can actually implement this formula in your own DeFi portfolio. A couple things that we're going to cover today is a live $50,000 portfolio construction using Metrics Finance. So that's the process of finding the positions. That's the process of simulating performance, adjusting ranges, validating them. That dives into real position validation and risk analysis. And then also what we would do in the instance of deployment and the process that we would take there. Tomorrow, we are going to be covering post-deployment and tracking. So this is what you do after you deploy your DeFi portfolio. Arguably, tomorrow is the most important session, okay? Because this is going to show you exactly how to track your performance. I know the majority of you here have been in DeFi for about 6 months. And as we discussed yesterday, the majority of people end up quitting DeFi after 6 months if they don't see the right results or their portfolio isn't performing up to expectations. And again, you guys have showed up here today. You guys are live. You guys have blocked off your calendars. It's very clear that you want to be in this industry and that you believe in it. Probably for some underlying fact, right? Because the banks are stealing money from us. I go and send a wire, whether it's, $20 or whether it's $1,000, I'll pay like a super high fee, right? If I go and I want to send money to a friend, it takes 3 to 5 business days, okay? We're all here in crypto and DeFi for a reason. So we don't want to be the ones that have to go to a different industry because we can't just figure this out. Everybody, as you mentioned, is here to stay. So today you're going to see every single click, every single decision, every single calculation, and it's going to be real-time implementation of yesterday's DeFi formula. Now, with that being said, as I said yesterday, if at any point in time you get a light bulb moment, you see something that you can instantly apply to your portfolio that is going to change the results of your portfolio and help you kind of get to where you want to be, I want you to say #alpha in the chat. Now, if you guys are ready for me to start, go ahead and just put #alpha in the chat right now. And we're going to go ahead and dive into Metrics Finance. Sweet. So I think we got the screen pulled up. Let me know if we're all good there. The first thing that we're going to dive into actually before Metrics Finance is something called Portfolio Vision. Now, this is something that we essentially built out specifically for our legacy clients, but I want to show you kind of the theory of it because while the software is pretty comprehensive and we won't be diving into the entire thing today because we will be diving into post-deployment and whatnot, we are going to be diving into some of the many things. And again, if you guys are in Liquidity Syndicate, you are going to get a workbook that's going to look somewhat similar to this. And that's going to help you throughout your kind of blueprinting and construct and deployment processes. So with that being said, when we are building portfolios, as I mentioned, the first thing that we do is plan everything out. So we are planning our total deployment amount. In this instance, that is $50,000. We are planning our portfolio APR, right? What overall portfolio APR do we want to hit? Now, in day 3, we will be covering some realistic expectations, like what kind of that range looks like. But in this instance, I'm just going to say around a 50% overall portfolio APR. And then we can document our current situation. We can scroll down here and start to document our deployment timeline. So our deployment timeline is how much of our capital is getting deployed over the course of 3 different months. So usually when we're looking at this total deployment amount, in this case of $50,000, right, we would ramp up 40, 80, 100% just as an example, right? But today we are going to be just deploying it all in month 1, day 1, deployment number 1, basically, for simplicity purposes. So we're just going to jot down 100% here. And we will set different performance targets for each sector. And ideally, as we're ramping up deployments, we are essentially getting validation, right? And we're saying, hey, this position is performing well. Let's deploy more. Or, hey, our portfolio is doing well overall. Let's open up another arm of the portfolio. Simple as that. We are documenting everything right here, right now. The next thing that we move on into is VRM analysis of specific assets. Now, I want to show you from a high level on how to do VRM analysis. We go over to CoinGecko, right? And to find new assets, so first we got to find some assets, we would go to the categories section. Now, on categories, you will see an extensive list of basically anything that they can create a category out of. Like they have the World Liberty Financial Portfolio. They have Made in USA tokens. So if that's stuff that you're bullish on in the crypto space, feel free to include that in your portfolio. What I like to focus on are revenue-driven assets. So that's going to be stuff along the lines of Render, Aether, GRT, stuff that actually has a business model behind it, is generating revenue for their business, they're profitable, and then they take that revenue and they inject it back into their ecosystem. We've seen time and time again, there's projects out there, they have a great model, they have a great, or not a great model, they have a great business, but they don't have a good business model. And what I mean by that is their business, it operates really well, they make a lot of money, but that money never touches the people that actually hold their token. And that's not right, because we're investing in the future of their company, and they are making money off of us investing, right? Us investing is allowing them to build the products, but then we have no share of the upside. Doesn't really make sense, does it? If somebody came to you and said, hey, I have this great company you can invest into, right? The investment is XYZ. You go ahead and say, yeah, this is a great company. I'm going to go ahead and invest into it. And then they're like, yeah, so the catch is you don't get any of the upside. You are investing in the future, but you are just speculating on the fact that somebody wants to buy your shares later on. And you're like, well, what the heck? Like, that doesn't make sense. That's exactly what a lot of people are doing right now in the crypto space. They invest into tokens that are not tied to revenue, that are not tied to the future of a company, but rather just hype-based, speculation-based, stuff like that. So a couple different categories that I like to look at are number 1 going to be decentralized finance tokens. So in this DeFi category, we're going to go ahead and open it up. And we're going to find stuff like our Lido staked ETH or Wrap staked ETH, but we'll also see tokens like Hyperliquid, Chainlink, Uniswap, Aave, Ondo, and we'll see a lot of those. Another category that I like to look at right now is going to be the real world assets category. And then another category that I like to look at is the artificial intelligence category. So let's start with RWA. You'll see we have stuff like Link, XLM, Buildle, which is BlackRock's USD, Ondo, Algo, Quant, and a ton of other tokens that are real-world assets. Same thing with artificial intelligence. A bunch of different tokens that have to do with businesses that are shaping the future of AI, and they're bringing that on-chain into DeFi. So we have Tau right here at the top. We have Near, we have FET, we have Render, we have GRT. We have a lot of them just kind of going on and on and on down this list. Now, real quick, I do want to do a quick intermission. If you guys do see me looking down, it's because I'm looking at my screen right here. I have a MacBook, and then if I'm looking over there, looking at the chat, right? Just seeing what you guys have to say. But for the most part, I will try to look at the camera, look you guys right in the eyes. But diving into this, let's just say some of the tokens that I'm bullish on. We have Render, we have GRT, maybe AIOZ. These are pretty solid tokens. We're going to take these and actually evaluate them. Now, you guys can use ChatGPT to evaluate these, or you could use this Portfolio Vision software if you guys are part of our legacy program. But with that being said, after we've kind of conducted our VRM analysis, which is scoring on those 4 categories, which just, once again, feed to ChatGPT, say score on these 4 categories. It's pretty simple. We'll move on into strategy categories. Strategy categories is actually mapping out our portfolio across these 4 different levels before we invest, right? So what do we want our ideal portfolio to look like? We have $50,000. How much do we want to have in HODLs? How much do we want to have in advanced strategies? How much do we want to have in lending? And how much do we want to have in liquidity pools? So in this instance, I'm going to have a heavy allocation to liquidity pools. Now, this is riskier than having smaller allocation to liquidity pools. The risk here is obviously divergence loss and the fact that maybe hodling could be better. Now, the reason why I do a heavy allocation here is because I trust my strategy and I know my strategy works. And I know when it doesn't work, I have contingency plans that make sure that I make my money back, get back to a break even, or of course, a profit. So moving on, the next category is lending. And typically, I like to do a 30% allocation over to lending and then maybe about a 10% allocation over to HODLs. Now, the reason why it looks something along the lines of this is because lending is going to be your blue chip assets. Even if we're not borrowing against them, I typically just put my Bitcoin, my Ethereum, my Solana, my Link, kind of the blue chip assets that I can lend out on a lending platform, because that way I'm ready to borrow against it. Today, we are not going to be talking about borrowing. We are not going to be talking about advanced strategies, because today is meant to be a DeFi 101 class, right? And today is meant to go over getting into DeFi and also setting up your portfolio. This is stuff that we don't usually implement until phase 5 of the DeFi formula, optimize. And then with our HODLs, the small 10% here, this is going to be basically altcoins that have a lot of upside exposure that we can't necessarily lend out. But if we can lend it out, I'm lending it out. And yes, we do have smart contract risk by doing that, which means ideally we do want to eventually implement borrows, but for the time being, we're just going to lend it out to start with. So this is what kind of our portfolio would look like. Right over here on the right, we would have $50,000 in which 30 grand is in liquidity pools, 15 grand is in lending, 5 grand is over here in HODLs. Now moving into the position types, we have crypto to crypto, crypto to stable, stable to stable. In our lending section, we have our crypto, our stable. In our HODLs, we also have our crypto and stable. We need to determine allocations here. So when we're looking at our crypto to crypto, typically I am going to do a heavy allocation of these. Either it's going to be 100% or it's going to be 80%. The only reason why I would do 80% is if I wanted to do a small allocation in crypto to stable in the instance the market is going sideways. If we look at CoinGecko and a general kind of overview of the market, I like to look at Ethereum, believe it or not, because a lot of the DeFi stuff is based on Ethereum, and also Solana. You could look at that too. But you can see Ethereum's kind of consolidating, so perhaps we do want to include about a 20% allocation to crypto to stable, because we're not going to have much divergence loss because the market is going sideways right now. There's not going to be much shifting of assets. Stable to stable, again, this is something that I'm not going to talk about today. That's more part of our DeFi stability roadmap, which is a whole nother roadmap that we have for remaining market neutral. And it's going to be the roadmap that we primarily use when the bear market comes in a little less than 6 months, most likely. Now, under the lending section, we have our crypto and stable. Typically, I'm doing 0% stable, 100% crypto. I will say there is the small instance where I have a couple $1,000s of stables just sitting on lending, right? And then that time I might have like 5%, 10% there, and then like 95% crypto. But for now, we're just going to assume 100% crypto. The reason why is because you're not going to get great yields lending out stablecoins. You are going to get great yields on stablecoins using stable-to-stable strategies, using counterparty vaults, using delta neutral positions, stuff along those lines. So moving forward, the next aspect we have are the HODLs. Again, same exact thing here, 100% crypto. Sometimes I have a couple $1,000s of stables on the side, which is a couple percent of my portfolio, but not a lot of the times. So after we've done that, that concludes the blueprint phase, going through portfolio goals, finding assets, conducting the VRM analysis, and planning out the portfolio and seeing what it's going to look like across different strategy categories and different position types. Do you guys have any questions so far? I'm going to go ahead and answer one main question right now. I want you to throw it in the chat. But with that being said, while you guys throw those in there, I'm going to move on to the construct phase. Don't see any questions coming through. Anything related to the blueprint phase, we go ahead and answer it. In the meantime, we're going to go ahead and start talking about construct. Again, make sure you have some questions prepared for the construct phase as well. So when we dive into the construct phase, under strategies, we have the option to create a new deployment. So this is kind of like what our first chunk would be. So in the instance where you're kind of setting up the portfolio, you're ramping capital up, as I previously mentioned, over the course of a month, 2 months, 3 months. In the construct phase, we're saying, hey, maybe we do want to allocate, 40% our first month, which would be 20 grand. Well, our first deployment is probably going to be less than 20 grand. Our first deployment is probably going to be something like 10 grand or so. We're going to ramp that up. Once it does well, maybe a week or two after, we'll deploy another 20 grand, or sorry, another 10 grand to total that 20 grand. But in this instance, we're just doing it all in one deployment. So let's create a deployment. We'd set the date, $50,000. Regarding this portfolio vision software, this is something that we do keep exclusive to Legacy. It's not something that we will ever license to the public. Simple reason why is because it literally goes hand in hand with our DeFi formula roadmap. I will say, you guys will be provided with a workbook by the end of day 3 that will kind of walk you through this exact same process that you guys can do. It'll just be a PDF document. You can print it out. You can write on it, basically, and it'll be a similar process, essentially. But yeah, this is a pretty intensive build out that we did for our team. So when it comes down to our new deployment, once again, we set our strategy categories. So under liquidity pools, we said 60%, lending we said 30%, HODLs we said 10%, and advanced strategies we said 0% for now. That's what we're going to do. But in the instance where you're deploying maybe your first chunk of capital, I would highly recommend your first chunk of capital is just heavily tailored to a specific category, right? So maybe your first $10,000 is all in liquidity pools, and you dive into one single liquidity pool with that $10,000. That's your first deployment, right? But in this instance, we're just assuming on an overall portfolio level. So with that being said, let's go ahead and hit next. Moderator is Esteban. He's behind the camera right now. He'll be speaking a little bit later on, so that's a surprise for you guys. But he is on our metrics account right now. So yeah, moving on into position types, we have our crypto to crypto positions. We are going to be doing a 80% allocation here and a 20% allocation to crypto to stable. In our stable to stable, 0%. In our stable and stable over here, 0%. We'll do it all in crypto. So we'll create that deployment, and now we can start to map things out, and we can start to draw the lines, basically. So we're going to dive into metrics finance now, because that's our next step. So on the Metrics Finance Discover page, this is where we use the Fate framework. As I mentioned yesterday, the Fate framework is diving in and saying the first thing, fundamentals. So what that looks like in practice is maybe we like GRT, we like, let's just say Aave, we like Link, we like Render, we like Aether, stuff like that. Under this filter section on Metrics Finance right here, if you go to the include section, you could just type out the assets and separate them with a comma. This will show us pools that include at least one of these assets, basically. Now, a cool little thing that we can do as well is if we're specifically looking for crypto to crypto pools, we say, hey, the pool must include Ethereum and can include one of these in order for it to be displayed. And right there, you see that we have 6 different pools. Again, it's not a lot to sort through. That is why we don't implement TVL requirements, correlation requirements, price volatility, or any of the other aspects of the Fate framework on the front end. We don't do that when we're looking at fundamental assets. We're just looking at these assets, looking at the pools, evaluating them, seeing if there's anything good, and then going from there. Now, I will say, while we are on the topic of Discover, I would highly recommend, at least right now, setting your calculation time frame to 14 days. And the reason why is because you're going to see an adjustment in the results. Ethereum to Link going from 16% to 8%. If we look at Ethereum to Aave, 30% all the way down to 21%. A lot of these have got hit with the APR drop over the past 14 days. The reason why is because the volume is not as high, and we don't want to be seeing super high numbers. And then when we get into simulate, we start to adjust our calculation time frame, we adjust our calculation method, which we're going to dive into all that and what that means in just a second. But we don't want to get kind of blindsided by a huge APR drop. So again, better to just look at 14-day calculation time frame. Now, with that being said, I might favorite a couple of these that look appealing, like Ethereum to Render looks pretty nice. It has 285K of TVL. So anybody remember our rule from yesterday? We do not make up for more than 10% of the overall pool's TVL. I will not deploy more than roughly 25 grand in this pool, right? And the only reason why we would break our $1 million TVL rule of thumb, where we go into a pool that has less than $1 million in TVL, is if there are multiple pools with at least $1 million TVL total. And then even then, we will not make up for more than 5% of the overall TVL across multiple pools. So we have 2 Ethereum to Render pools right here. Total's about 1.3, 1.4 million or so. So in that instance, I'd be completely comfortable diving into this one with 285K in TVL if it is doing a better return. And we'll dive into all of that in just a sec. Now, over here, we also have Ethereum to link at 65%. We can dive into all of these. So let's just go ahead and throw those on the favorites by hitting this little star. And then we're going to go ahead and delete those for now. Now, another thing I will say is you want to do segmenting. When we are looking for exchanges and networks, typically we are doing Uniswap, QuickSwap, PancakeSwap, and SushiSwap at the same time across whatever networks you feel comfortable on. These are kind of the ones that I'll dive into. I don't really care too much for AVAX, CeeLo, Polygon ZK, EVM, or Manta Pacific. And ultimately, I segment. So I look across these networks first when I'm applying the first aspects of Fate framework. Then I'll go and I'll look across Orca and Radium, across Solana, obviously. Apply the same exact framework. And then I'll go and I'll look at Velodrome and Aerodrome on the Optimism and Base network. Again, once again, applying the other aspects of Fate framework. The reason why we do that is because Solana has very different data than Ethereum. It will a lot of the times have higher fee to TVL ratios, higher trading activity because it's a cheaper chain to use. But what that does not factor in is people also have a super tight range a lot of the times on Solana, which causes them to kind of eat the yield. So the yields could be similar, could be a little bit different, could be higher, right? But it has more volume. And then with Aerodrome and Velodrome, you have staking and unstaking, which, again, we want to make sure that we don't mix those things up because ultimately that's going to be a different model than these four to start with. But I will go ahead and use these four for this example. So we're just going to reset this and use these networks and exchanges. So we have 3,117 pools. That's a lot of pools to sort through. And that is where we start to apply the other aspects of the Fate framework, the ATE. The A is going to be the APR. Now, as we mentioned yesterday, we use an APR of 50 to 500% typically. Or if you are wanting to go for lower risk positions, you can do 30 to like 300% or so. So in this instance, we're going to capture that whole range. We're going to do higher than 30, lower than 500. Ultimately, the reason why we do higher than 30 is once again because once we start to dive into this, once we start to adjust the ranges, we can easily get higher than what the APR that's displayed here is. So this is 41%. Perhaps we can maybe get 50% once we start to tighten up that range. So with that being said, I'm going to grab a sip of water, but if you guys have any questions, feel free to throw them in the chat. We are stacking them for later on when we do the Q&A. And if there's anything valuable that you can immediately see a change in your portfolio, that is why people are commenting #alpha. And that lets us know what you guys find beneficial so we can better tailor the next session tomorrow. Awesome. Let's move on in. So the next aspect of Fate, now that we've put in the APR filter, we put in the TVL filter. We are looking for higher than $1 million as our TVL. Again, the breach to this TVL factor is if we want to look at something higher than $250,000, which we can manually set. On the Solana networks, I will usually put higher than $250,000 just because there are a lot of the times lower TVLs over there. But the other thing that we will factor in is when we're looking specifically for assets, like kind of like we did at the start where we said we want to include these specific assets, and we're looking at the fundamentals, that part is the primary reason why we would breach the TVL, because we truly believe in the asset and we saw the pool ahead of time. So we don't have to worry about it getting filtered out because we already looked at it ahead of time. Again, only breach the TVL factor in the instance where you truly believe in the assets. The next aspect of TVL is the daily fees to TVL. So daily fees to TVL is an indication of how much trading activity there is compared to the overall TVL. Same thing for volume to TVL, but I just like to look at the fee one because this shows us the actual fee earnings because there are a bunch of different fee tiers over here. So one could have $1 million of volume and be 1% fee tier. The other one could have $1 million of volume and be 0.3% fee tier. It's obviously going to be a huge difference in actual fees collected there. So that's why I use daily fees to TVL. It shows us essentially actively traded positions with high fees compared to the overall TVL liquidity pool. What does this mean? This means that there's less competition for us. We can essentially deploy our capital in this pool and not have to worry about other liquidity providers because there is essentially more demand to trade this pair. So when we look at this, we sort by the highest one first. So we just click this it's going to sort it, and it's going to show us, in this instance, 2.65%, 1.02%, 0.84%. It's going down, basically. It's showing us highest first, lowest last. Now, since we have 120 different pools here, after applying the APR and the TVL filters, we will scroll down, and we have 12 different pages. We will go over to page 6 right here, and this is kind of going to be our middle ground. We will find the middle ground fee to TVL ratio. That is 0.0374%. And we will click on this little filter icon and do higher than 0.037%, let's just say. And that cuts us from 120 pools to 60 pools. And it actually shows us the better half of the pools, the ones that have higher trading activity compared to the overall TVL, the ones that have more demand compared to the overall TVL. So that is one of the things that a lot of people fail to do. A lot of people ask me, what do I put my daily fee to TVL ratio as? And I can't give you a number because this thing changes literally every single week, basically. The number that we use changes every single week. And it depends on different exchanges. That's why we segment, because Orca and Radian, they will have higher daily fee to TVL ratios than these 4 exchanges that we have selected. So ultimately, the reason why we filter by this and the reason why we sort it is because we want to look at the better half of liquidity pools. Now in this instance, let's just say we want to look for a lot of different options. I'm going to take the fee to TVL ratio off. Again, that's 120 pools, but I'm confident that we can start to sort through these once we start to put in our correlation, once we start to put in our price volatility and other, filters. So with that being said, we're going to look at higher than 0.5 correlation. This is the next aspect of fate. It is going to be the exposure factor, where we're looking at correlation as well as price volatility. I did see somebody in the chat. They said zero value, just promotion of your software. You guys can do this on DeFi Llama if you want to, right? We can go over to DeFi Llama just like this, and we go to yield section, and this is completely free, so you can go and use that one. But over here, we can put in the correlation above 0.5, and then price volatility, we can look at lower than 15%. Just like that. So that's going to show us 44 different pools. So again, I had 120 pools. Just applying these filters right here, correlation higher than 0.5, price volatility lower than 15, that shows me 44 different pools. And the thing that I can do here is start to just sort down and see what I truly want to include in the portfolio. So there's the Ethereum to render. I know we already bookmarked one Ethereum to render, so we can just throw that to the side for now because we're going to dive into it a little bit later on. If we head over here to page 2, we'll have some stuff like Ethereum to Lido, Ethereum to Uni. Now you're probably wondering, well, Jake, how do you decide which ones to essentially simulate and go further on? Well, the way that I decide is I usually just pull up the assets on CoinGecko if I haven't heard of them. And if it looks somewhat appealing, serious branding, serious asset name, like something like this. This token, don't even know how to pronounce it, but it is some random icon, right? Clearly a meme coin. Not going to dive into that. I don't want to dive into meme coins. So ultimately, I'm just going to skip past that one. But something like Puffer. Puffer, I don't know how that can be taken. That could be a meme coin, right? It could not be a meme coin. We pull this up. You can see that, the icon. And the cool thing is these icons are actually pulled directly from CoinGecko. So if we go over to CoinGecko, we just type in the Puffer asset, pull it up over here. CoinGecko will sometimes give us a little bit of a detail of what Puffer is. So it is a native liquid restaking protocol built on Eigenlayer. So this is an actual asset. It is not a meme coin, right? It has professional branding. Yes, it's based on a fish, but that's just kind of like DeFi. DeFi is a little bit weird at the end of the day. But ultimately, we can kind of go down that rabbit hole, make sure that we truly believe in the asset, and kind of go from there. So with that being said, another one that I will bookmark is going to be Ethereum to ENA. Because I imagine Ethereum to ENA, it's going to be relatively correlated to Ethereum in the coming weeks, simply because Ethereum is obviously Ethereum, and ENA, Athena is another Ethereum-based project, and they have pretty tight correlation usually. Move on into page 3. We have Ethereum to Safe. That looks pretty solid. We have Ethereum to Fluid. Keep on going down. Over here on page 4, we have some more meme coins. Again, I can skip past a lot of this simply due to the fact that I haven't heard of this. There's the DAI over here. Not sure what this is, so pull that up. 01 Labs. And in this instance, it doesn't give us much information on CoinGecko, but if we pull this up, it's a MCP data layer. So model context protocol, and it's for artificial intelligence using contextual intelligence. Again, a lot of this is beyond me, but we'd use ChatGPT to conduct VRM on these assets, assuming we are unsure of kind of like what they are. Move on to page 5. We have a couple more assets. So With that being said, I'm going to go ahead and select every single exchange, every single network, and we're going to go ahead and just reset these filters by clicking this button right here. And then that way, when we go into favorite pools, we have a list of them over here. Now again, just to recap, we look at fundamentals first. We search for the assets that we believe in. We type in Tau, Render. We don't type in Ethereum here because, well, you can practically pair anything with Ethereum almost, at least anything on, the Ethereum network and whatnot. So if we want to look at stuff like that paired with Ethereum, we type in Ethereum over here. In this instance, I'm also going to include Tau in the portfolio because this is a solid position. However, it doesn't have as high of a correlation over the past 14 days. So we'll want to investigate that. And that's why we always look at fundamentals first, because if we actually know the assets, there might be opportunities like Tau, which are good opportunities or something along those lines. And then we start to simulate, and of course, they turn out to be good opportunities, but they just don't look good on paper. That right there is why we always look at fundamentals, and we always look for assets first. And then secondly, we look for pools with assets that maybe we haven't discovered yet. So seems like we have a lot of Uniswap positions. You guys probably know if you watch the YouTube channel that I am heavily invested into Uniswap platforms and on the Ethereum network, just because that's what I'm bullish on. That's what I find the best. So we're going to go ahead and start with just simulating a couple of these. So we're going to pull up Safe to start. We're going to go from the bottom, just over here. And the first thing we'll do on this page is our pre-simulation action steps, which are our pricing quotes, so safe per Ethereum, as well as our deposit amount. So in this instance, I like to deploy typically $20,000 per position or so, but we have $50,000 total. And again, not all of that is going to be allocated to liquidity pools. We'll allocate some to lending, some to hodls, right? And stuff along those lines. But we're primarily focusing on liquidity pools today. So 24 grand in crypto to crypto pools, 6 grand in crypto to stable, and then we weren't supposed to have any in stable to stable, so we'll just ignore that for now. Made a typo. But with that being said, diving into Ethereum to safe, we'll do $12,000 just to start with. Usually I do like an equal split. So if I have, say, in this instance, $24,000 to deploy into liquidity pools, and maybe I want to deploy into 2 liquidity pools at this scale, then I'm going to do 12,000, 12,000. And later on, when we start to look at risk-adjusted return and other factors, that right there is where we're going to start to narrow that down and say, hey, maybe we want like 15 grand in this one and then 10 grand in this one. That's a little bit more risky. So diving deeper, now that we've done our pre-simulation action steps, we start to find our range using the range framework. So again, what we do here is we start at the very top and the very bottom. We put our range just using the past 30 days of data. The reason why is because we look at time span. I want to be in this position for roughly 2 weeks. So I multiply 2 weeks by 2, right? We always want to look for 2 times our time span, which is going to give us about 28 days, let's just say. And then we put our min-max price at the high and the low to start with. And then from there, we'll start to refine this range. The next aspect is obviously going to be correlation. Correlation, if we have a higher correlation, which in this instance we have 0.88, then we can go in with a tighter range. Now, you'll already see that this is a plus 4% minus 13% range. So it's already a relatively tight range. Do keep that in mind. And if we go down, the next aspect is the notable fluctuations. So if we were to see one of these pumps over here, which can last basically about a day and a half, let's just say, let's look at this kind of area. That is from a price of 58.81 all the way to a price of 63.05. So if we pull up this percentage calculator, 58.01 to 63.05, that right there is going to be an 8.68% increase in price. So we want to make sure that we can capture that pool price in our actual range. So we'll adjust that because we had a range of plus 4% as our top price. But if we can easily go up that much in a day and a half or so, well, then we're instantly going to go out of range if it starts to go up. So we bring that up to something probably like 10%. We add a little bit more buffer room. And then from there, we look at the gain loss trend. We can clearly capture, the downside notable fluctuations, so that's no biggie. But the gain loss trend is what's happening with this position. Well, in this instance, it's slowly trending up. Then there was a period where Safe completely killed it, did very, very well. And then obviously it's kind of getting back into correlation with Ethereum. I like to zoom out a little bit during these times. In this instance, you could see this period where the price is trending up, Ethereum is very, very clearly outperforming Safe. If we look at the past 365 days, if there's data for this pool, Ethereum is very, very clearly outperformed Safe. So just something to keep in mind. Now we'll go back down to 28 days, which is kind of where we want to simulate. and we don't really need to adjust the min price too much. And the reason why is because it was pretty clear that Ethereum did outperform safe, and that's where the trend is. The trend is up, so we want to make sure that we're capturing that upside. And the next aspect of the range framework is going to be exposure. So in this instance, we have 60% safe and about 40% Ethereum. But again, we said Ethereum is the outperformer here. Yes, there was a period where safe did well. We do have to keep that in mind because there could be a trend shift, as it somewhat looks like. But at the same time, the data is telling us that Ethereum has been outperforming safe. So we're going to go ahead and set our max price just a little bit higher, right? Because we want to start offloading a little bit of the safe and putting it into Ethereum. And we're going to get a little bit closer to 50-50. So we essentially need our max price to be further away from the current price to be able to get more Ethereum. But the other instance is we can bring our min price closer, which is also going to give us more Ethereum. So just something like that. And if we zoom out, look at 90 days or so, we'll capture the recent data. As you can see, pretty solid range. We would have been in range essentially 98% of the time ever since June 10th, which is the period that I'm analyzing. I'm analyzing the past 28 days or so, and this gives me roughly 28 days of data. So if we go to 28 days again, right, we'll start to conduct the rest of our analysis. So after the range framework, we want to make sure that this APR estimation that we see here, the 76% APR, is accurate. So there's a couple things that we do here to make sure that it is accurate. Number one, we will look at the liquidity distribution. Right now, in range, there is 3.1K of liquidity, 3.2K of liquidity, 3.2K of liquidity, right? It's pretty solid. Over here, there's 4.9K of liquidity. If we assume that we are on these price points over here, then we are getting roughly 41% APR in this area. Now, the thing is, this is out of our range, so we don't really have to worry about this too much. We also have a relatively broad range, so it's going to be a while before we get here. We just have to know in the back of our mind, hey, if price starts to move, or maybe these people move their liquidity in range again, we are going to get a lower APR during that period because there is 4.9K of liquidity per tick right here. And then over here, there is 3.2K. So there's less, so we make up for a higher share of this little tick over here, and that gives us a higher share of the overall fees. So I'm going to go back to this calculation method, which is what we just adjusted. If you click on the screen, it sets it on the price, which is pretty cool. But you can also just type it in manually through custom price, or you can select one of these options where you do the peak of distribution in range, the average liquidity in range, current price, stuff like that. So let's just do average liquidity in range. Gets us about 76% still because we have 3.1, 3.2, 3.2, 3.1. Basically, it's all around the same area. So it's not going to drastically adjust it. But that's going to give us a 76% APR. The question is the volume consistent? So now that we've kind of done the whole entire simulation process, we can start to refine this calculation time frame because we don't have to select a range anymore. We've determined our range is 55.12 to 69.36. Simple as that. Now going down here, we look at this volume history. This is pretty inconsistent volume history if you ask me, but inconsistent in a good way, meaning that recently we have had a huge spike of volume. So sometimes you will see opportunities where there was a huge spike of volume in the first part of the month, and then the volume that's happening over here where it's like 65, 35K a day or so, that's the recent volume, right? And ultimately that means you don't want to simulate looking at volume, from a month ago or so, when recently it's not been doing that whatsoever. You want to cut those days out. In this instance, we want to cut out the bad days, okay, over here because we're doing better recently. So if we set our calculation time frame, something along the lines of 14 days, that average is going to get a little higher. So you'll see going from 28 days, the average is 92K, and going to 14 days, the average is 138K, which is going to make our APR higher. Now, here's the thing. A lot of you may say, well, Jake, why don't you just use July 4th all the way through July 8th? Well, the reason why is because volume is trending down. We saw a huge influx of volume, right? And we are still doing higher volume than before, higher volume 30 days, right? This is 75K in a day, but we do have to factor in that volume is trending down, which is why I'm not using, if I use a, say, 5-day calculation range, it's going to show our average is like 300K a day, which is very, very, very far off from what we have started to decline to. So again, 14 days or so, I like to capture some of that bad data just so I have a more reasonable estimation of what this APR is going to be like. And then from there, that tells us, hey, it's about 115% APR. Even if we just look at the past day, which is 75K of volume, you can see that we're going to be doing a 62% APR. Either way, this is a good APR. And the reason why is because we have super high correlation. Safe is a pretty solid asset. And we've conducted our VRM analysis on this, obviously, by now. Same exact concept. So again, 14 days. And after we have done that, we are going to save this to our portfolio because we have finished conducting our analysis for our range as well as our APR. But there is one last step before we truly are ready to deploy our capital into this, and that is validating the position. So validating the position is making sure that we are comfortable with the volatility that we have. So when we're going into CoinGecko over here, we're going to want to pull up Ethereum as well as Safe. Pull up both those on CoinGecko. I got them right here. And we're going to see what can happen to Ethereum and Safe. Now, if I just like look at these charts side by side, very closely correlated. The only really difference is over here, Safe shot up, Ethereum didn't go up nearly as much. So what I'm going to look at is kind of a period where we saw pretty decent incline. We can use this period right here, 2182 all the way up to a price of 2403. So that's from the 22nd to the 24th. It's about 2 days. So 2182 to 2400. Let's see how much percent that is. 2182, 2400. Ethereum basically went up 9.99%. So if we take its current price, if I simulate position performance, Ethereum is currently at 2661. And we just multiply it by 110% because it went up 10%. Gives us 2930. 2930 is the price that we are expecting Ethereum to go to, let's just say, if we see a pump in the market like that. We will type in 2930 right here, and that says plus 10%. Boom. Next thing that we will do is do the same exact thing during the same exact time period for Safe. So when I'm looking at this, Safe on that same period over the course of 2 days went from 35 cents to 41 cents. So let's just say 35 to 41. And that's about a 17% gain. So we're going to multiply the current price of Safe, which is 0.43 or so, by 117%. And that gives us the price after a 17% incline. So basically 0.503 is what we are going to use. 0.503. We'll go ahead and just type that in right over here. And that's a plus 17% gain roughly. That created divergence loss in the pool. If we look at this opportunity cost, you could see that's $106. $106 of opportunity cost. So how long does it take to outweigh that? We saw $106 of opportunity cost in the time span of 2 days. Well, in this instance, it only takes roughly 3 days to outweigh that opportunity cost. That is a good simulation right there. The reason why is because we simulated what happens when there's volatility in the market where there is breaks of correlation. And then we determined if there is a break of correlation, here's how much divergence loss we will have. And we are understanding exactly how long it will take to outweigh that. And if it takes too long, right? If it's taking, let's just say, a week to outweigh 2 days, that's not so bad. But if it's taking 2 weeks to outweigh 2 days of volume, I'm probably not going to be diving into that liquidity pool unless it's an absurd circumstance where we saw a huge break for no reason. Maybe there's FUD or something like that. But in this instance, 3 days to outweigh 2 days, that right there is good. The only better thing than that is if it takes a lower amount of time of fees to outweigh the same exact period of volatility. So right there, that's going to be some alpha, okay? This is the number one way that we make sure that we don't get hit with divergence loss surprises. We simulate and we map out every scenario before we invest. As Cons, which is our client success manager at Builder Wealth, says, if you know every outcome, there are no surprises. Great quote. Ultimately, that is what we're trying to do here. Know every single outcome before we deploy. So in that instance, I had already saved this to the portfolio. We haven't made any adjustments. So we're just going to keep that there. I'm going to go ahead and speed run this next one, okay? Again, we're doing this completely live. We have not even looked at these pools beforehand. I'm looking for 2 pools or so. So the next one we'll do is, let's just say, Ethereum to Tau. We'll go over to the Discover section, go to our favorite pools. We have Ethereum to Tau over here. Start with this one. Load it up. Now, in this instance, it's actually pretty surprising. We have a huge chunk of liquidity right here, 525K on this singular price point. And then over here, we have 54K. Over here, we have 43K. Over here, we have 6.1K. So again, if we want to check like other options Esbalton's going to be diving into that in a couple minutes, like exactly how you can check to make sure you're in the best Ethereum to Tau pool. But the other thing you could do is just pull these things up side by side. So this one that we have up over here is the 1% tier, and it's showing 7% or so. You're probably wondering, why does it show such a big difference right now? Because, of course, it is using data right here. You know what I mean? Price is right over here. And then ultimately, if we dive into this one, it will probably be a little bit better. So maybe we should look at this one to start with. Ethereum to Tau, 75%. That's a lot better. Okay. And then if we look over here at our min and max price, we simply want to start by adjusting this calculation time frame to 28 days, adjusting this deposit amount all the way down to $12,000 is what we chose. Make sure we're looking at Tau per Ethereum, so we look at whole numbers, not the little decimals, basically. And then from there, set our min and max price to the top and bottom of this pool price chart. Now, just saw a question in the chat that I want to clarify very, very quickly. It said, how do you decide what LPs to add to your product? I think you're asking, how do we decide what LPs to add Metrics Finance? It's all automatically added. That's the best part of Metrics. If a new liquidity pool pops up tomorrow, as soon as it starts to accumulate some TVL, it's going to be shown at Metrics Finance. Simple as that. Just because we pull all the data directly from the blockchain, we aren't another tool that just pulls from DeFi, Llama, CoinMarketCap APIs and wraps that with like 10% of what they offer. That's like not what we do. We reinvent the wheel because there truly is no tool out there like Metrics Finance, and that is exactly what we are focused on here. Now again, if you want to use DeFi Llama, completely fine. I use DeFi Llama on a daily basis. But we'll head over here, calculation range at 28 days. We'll start to adjust this range, min max price. We put that at the high and the low. From there, we're looking at correlation. In this instance, it is a 0.66% correlate or 0.66 correlation over the past 30 or 28 days. If we look at the past 14 days, you're going to see that correlation is significantly lower at 0.15. That's because we saw a break of correlation during that time frame. So we do have to keep that in mind. But if we look at the past 7 days or so, that correlation starts to get a little bit better at 0.42. If we look at the past 5 days, correlation back down to 0.21, right? If we look at the past 3 days, right? Correlation 0.18. So we do have to be mindful of this. And I just want to show you guys this as an example to see if there is an opportunity where we can outweigh all of that. So the next thing that we're going to do is notable fluctuations. We are very, very close to the top range. So if we go ahead and look at what can happen to this pool price in the time span of, let's just say a day, we go from, I want to look at a kind of reasonable period, like right over here, 6.74 all the way up to 7.26. So 6.74, 7.26. That's like a 7.7% gain in the price. We have a plus 1% range. So we're going to adjust our max price to be plus at least 8%, but then I usually like to bring that up a little bit further than that just to allow a little bit of buffer room. What happens if it goes a little bit higher? So from there, we do our max price, let's just say 9 to start with. Next thing is the gain loss trend. Where's the trend going? Well, if we look at the past 90 days, you can see it's very, very clear that Ethereum has been outperforming Tau. Ethereum has been outperforming a lot of altcoins recently. Main reason why is because Ethereum before was pretty freaking dead, guys. So it's starting to see a little bit of a run. We see Ethereum season completely normal right now. And then when we see altcoin season, that's exactly where money starts to flow into altcoins and they start to outperform. If we look at the past 365 days, though, maybe this pool hasn't been around for that long. Okay. I don't want to let you guys sit on the loading page forever. But ultimately, if we were to look at the past 365 days, what you would see is essentially there are periods where Tau does a lot better than Ethereum, and Ethereum does a lot better than Tau. Kind of like this period right over here. So again, going back down to 28 days, we are now knowing the trend is Tau underperforming Ethereum, and the price just going up. So we're going to adjust this min price because we're pretty far off from where we're currently at. We'll bring that up a little bit, which is going to get us a little bit less Tau and a little bit more Ethereum. And then we're going to bring that max price up a little bit to get a little bit more Ethereum because Ethereum is the asset that is doing better right now. But there are periods where the altcoins can start to do better. Now, something that I like to do and just factor into my ranges, personal tip, is if Ethereum's outperforming, generally you still want to have about 50-50 with Ethereum and the altcoin. The reason why is because altcoins will always outperform Ethereum, just like Ethereum will always outperform Bitcoin percentage-wise over the long haul, basically. because they're just simply smaller market cap assets, right? And that can flip at any given time. So by doing a 50% allocation to Ethereum, it allows me to capture when Ethereum does do better, but at the same exact time when the altcoin starts to do better, I still have exposure to it, if that makes sense. So if we dive into this, the next part is exposure, obviously 50-50, we're good here. And yeah, I'm pretty happy with this. The next thing we'll do is APR calculations. So over here, you'll notice we're at this area where we have roughly 22K of liquidity. Over here, we have 29K of liquidity. We just simply click over here. We now have 93% APR. We go from that APR of 134% to 93%. And that is at the absolute peak of liquidity distribution. That is still a solid APR for this. So ultimately, we're going to go ahead and look at our volume history now. Volume history is showing an average of 1.1 million. If we look at these recent days, it's looking like we're doing about 700K or so. So I want to use since June 25th, essentially, which will be about 15 days or so, I think. 15 days. Gives us about an average of 830, so maybe let's do 14. There we go, 775. And then right there, you'll see our APR drops to 65%. Still, pretty solid APR for a position. Don't get me wrong, because we have a broader range. We're not going to have to manage this nearly as often. And yeah, that's a pretty accurate calculation. Now, what do? We simulate the position performance. So with Ethereum, we look at this period. We already know what price Ethereum went to. It was a price of, I believe, around like 2,900 or so when we did the math. Is plus 10% times 110%. Yeah, 2,900. So we'll just say over here, what happens when Ethereum goes to 2,900? And then with Tau, let's see. We just want to pull this up as well on CoinGecko. Look at the past month. Look at that same period. Tau went from like 300 basically all the way up to about 350. So 300 to 350. 300 to 350, which was a 16% incline for Tau. And Tau's current price is 328 times 116%. That'd put Tau at $380, let's say. $380 is the future price of Tau. So in this instance, where Ethereum goes to $2,900, Tau goes to $380, that's going to create a little bit of divergence, $88. In that instance, we only need 4 days of our position fees to outweigh that divergence loss, which is right on. We say we want 2x the time frame to cover opportunity costs and divergence loss. If we can see that type of divergence in 2 days, we want to be able to cover it within 4 days, ideally. The only instance where I would kind of allow an exception to that rule is if it's under 7 days. Like if you're looking at, say, 2 days or something, you can cover it in 7 days. Because again, a lot can happen in a short period of time. But if you're looking at something like a jump of over the course of 7 days or a jump over the course of 2 weeks or something like that, and it's taking like, 5 times the amount, 3 times the amount or something like that, ultimately, like that's not going to be a good position to dive into because that's a broader horizon. You could see a lot more divergence over the period of time. And we do end up simulating the decline of both assets just for time's sake. We are not doing that today, but it will be a similar kind of outcome because usually what goes up correlated is going to come down correlated as well. Like if we look at this, like over here, this is going to be like a relatively similar decline. It's the same incline that we saw over here, and same thing for Tau. So yeah, that tells us that, hey, this Tau position, solid position, this is something that we are okay including in our portfolio. So we will save this to our portfolio. Simple as that. Now, the next thing that we're going to do is make sure that these numbers are the best that we can get. We're going to be diving into the build section of Metrics Finance. And we'll be bringing on Esteban in this section.
Hey, so I'm Esteban, one of the main developer behind Metrics Finance. I've been here since almost the beginning, and as Jake mentioned, I'm going to show you how to use the build and the pair features. So, assuming that you now chose your pairs, or at least a few pools, what you can now do is verify that your strategy, that your portfolio is the best it can be with those pairs. So you can start with by going to the build page, this will allow you to see a quick summary of which pools, which pairs you saved. And then what you can also do is go to the pair page, which you can find at the top of the simulate form page. And this page will basically allow you to find new pools associated with the pair you would like to invest in. In other words, you can just select a pair that you want to invest in and use it on the pair page. For example, here I'm going to select Rapis and Tao. So, and the second token being Tao. Sorry. And then it basically will give me all the pools associated with this pair. However, what is great with this pair page is that you can also select which exchange and which network you wanted to use, and as well as the similar asset feature. This is a small feature that we're kind of proud of because it will be very useful. So here you see that the pool we use is on Uniswap Ethereum, but what we can do is just select a few more exchange. You can basically select the protocols, so the exchanges and the networks you would be comfortable using. So let's just select a few ones as a demonstration, but of course you can just use whatever ones you want. So let it load a few seconds. And here, so our pair is still selected, but what we can do now is turn on the similar asset option, and it will basically allow us to see a few more pools. So here we see that we do not have any others. So we can, for example, try to select a new exchange. And if we still don't have any other pools, this isn't necessarily a bad thing. It actually means that we could have selected the correct pool already. So in that case, with this pair that we selected, so what is to Tao, what we can see is that the only two pools that are available for us are this one, so basically the 0.30% feature one and the 1% feature. So we see that we already have the 0.30% feature one in our portfolio, which is a great thing because as we see now in this pair page, we can compare the simulations, and the one that we already have in our portfolio is already the correct one. So this is all right. The first pool is validated. Let's now try with the second one. So we can just repeat the same method. So just go here and here, just use the safe token. So with the same settings, or you can of course once again edit your filters if you want to use something else with the similar asset selected once again. And here again, we see that the pool that we selected is the correct one because we have no other pools. Just as a quick demonstration, for example, if you had used another asset, because I want to show you how it actually works when you have other potential pools. So here I selected, for example, a pair that will show many options because, for example, Rapis to USDC is a pair that will be associated with way more pools. In that case, you see that it actually takes a bit more time to load, basically also because I selected this similar assets option. And now, for example, as you can see, I just have like so many pools that are currently loading. It's taking a bit of time because, of course, this pair page fetches a lot of data. But it's just to show you that in the case where you would actually be loading pools with, pairs with more pools, you could be able to use this pair page to, find more pools. So in that case, it's still loading. And what you can see is that if, for example, we wanted to have a Rapis to USD or USDC pair, by selecting this similar asset feature, we could even see like, for example, USDT, USDC, so these similar tokens, which is great. And of course, once again, this was just an example because I wanted to show you the pair page in action with a pair that would actually show more pools. So let's just go back to what Jake saved in his portfolio. So here, as we can see, and as we just validated, we do have the correct pools. So for those pairs that we want to invest in. And one last thing we can do with this build page, which is quite interesting to do, is first thing at the top, you can verify your performance of like the whole portfolio, which is cool. Here we see that the average yearly APR is 90%, which is great. It's quite solid. And here you can also see the total deposit amount, which also matches with what you want. So that's great. And one last feature on this page, which is very good and that you need to do, is once again, stress test your portfolio once it's all ready. So what you can do is simulate portfolio performance. And here you can just use like the exact same prices that you used at first. So when simulating each pool, one by one. And here you'll basically be able to use, for example, the prices. So for safe, what we had said was 0.503. Then for wrapped ETH, we had said 0.930. And the future price we had used for Tau was 380. Great. And now we can see that the whole position performance is still quite acceptable because it will only take 2.56 days, to cover impermanent loss, which is great. It is solid. And as you can see, this pop-up is similar to the one Jake just showed on the simulate page, but in that case, it actually allows you to simulate the whole position performance, so of the whole strategy. So once you're done with that, it's great because it shows that not only each simulation, each position is good, but now your whole portfolio is validated because even the simulations here show that you're okay because your opportunity cost / impermanent loss is good. And if you actually stay in position in this simulation more than 3 days, then your liquidity providing strategy is okay. So that's all for those two features, and we're going to head back to Jake for the rest of the methods.
Awesome, guys. Let's give it up for Esteban. So, as Esteban was saying, portfolio is validated, right? Portfolio looks good. And ultimately, what we are trying to do on that level is see if we have portfolio synergy, see if the portfolio complements each other, and see if the multiple positions that we have in the portfolio can build off of each other. So now I want you guys to kind of go ahead and just ask some questions in the chat while I pull up my presentation again. But we'll get those answered whenever we dive into the Q&A. Awesome. Let me know once you guys can see my screen. So everything that I just showed you is completely implementable on your own. You can do this all on your own, and that's what I first did when I got into decentralized finance. But here's what most people don't realize. There's a big gap between actually knowing all this information, everything that I shared yesterday, everything that I've dove in today, and actually doing it, actually implementing it with the actual opportunities that are tailored to your risk tolerance, your portfolio. So one saying that I've heard before is having the map doesn't mean that you won't get lost. You can have a map, but you're going to make a wrong turn. And that wrong turn is going to cost you time. Sometimes that wrong turn is going to cost you money in the DeFi space. So there's a hidden cost that comes with just kind of going about this on your own. Most people are going to make one of the following mistakes. Either just common mistakes that will cost them thousands of dollars. They'll pay the ignorance tax because they don't know what they don't know. And they'll have risk that they don't even know exist yet. And of course, this will cause about 80% of DeFi investors to lose money and quit within their first 6 months or so, kind of right at that mark. Now, one wrong move that you make in decentralized finance can wipe out months of your gains. And that's kind of like where we created our DeFi Legacy program. It's our flagship program. It's a white glove service where we work side by side serious investors. But there was one thing about our DeFi Legacy program, and actually feedback from a lot of you guys in here today, that kind of kept me up at night, and it made me think creatively and a new solution essentially. So we discovered a huge gap. We had this amazing and advanced program. We had people that would go through other coaching programs first and then come to us when they want to take things further, right? But there was no bridge to actually get from being just a beginner in DeFi or not really having much of a strategy to now being in our DeFi Legacy program, which is why today we created something called the DeFi Formula Bootcamp. Now, before we dive into exactly what this is, I want to ask you guys a quick question. Are you currently holding crypto and watching others make an insane amount of money or just make consistent yields while you sit on the sidelines? Or potentially you're dabbling in DeFi, but feel like you're flying blind because you don't really have a real system or strategy like we broke down yesterday and today. Or maybe you're struggling in DeFi and you're just tired of losing money because nobody showed you the right way. You're chasing APRs, you're racking up a bunch of divergence loss, and truthfully, it's just better to hold Bitcoin and Ethereum. If any of these hit home, if any of these resonate with you, I want you to keep listening carefully. The DeFi Formula Bootcamp is meant to be your stepping stone to 6 or even 7-figure portfolio confidence. Because truth be told, guys, the max capital that we've deployed in the DeFi formula system, specifically within the DeFi industry in liquidity pools, is over $10 million for one single investor. And this formula works anywhere from 10 grand to $10 million from what we've proven. Now, with that being said, by being a part of this bootcamp, you guys are going to be getting access to our full DeFi formula system. Usually you have to join our DeFi Legacy program, which is $9,800 just to get access to this DeFi formula system. You're also getting access to our Portfolio Vision software. We're going to give you a license, the exact one that we showed you today, and that was just 10% of what this thing has to offer. Again, this is your personal workbook for progressing through the DeFi formula roadmap. On top of that, you're getting access to our Metrics Elite software, which is usually $600 if you were to pay for it separately. And that's the new tier that we just released that allows you to track everything in one place, allows you to view advanced correlation data, and view advanced data overall. We're also doing 2 weeks of intensive implementation and live Q&A sessions, which means that's going to be me on a live call answering your questions with other people that are in the same spot as you. And we're going to be doing it for 2 weeks straight to ensure that week 1, we can capture US-based time zones, and week 2, we can capture international-based time zones. So there should be no reason why you won't be able to show up. And with that being said, you have all of these things for 6 months of access. Now, to dive a little bit deeper into those live implementation weeks, as I mentioned, week 1, we will be diving into the full DeFi formula process. Day 1 will be Monday. We'll dive into Blueprint. Day 2 will be Construct, so on and so forth. And those will be hosted at the same exact time this call is hosted at the first week, and then those will be hosted at 9 p.m. Eastern the second week. So 5 days each day, and again, you could show up to both if you want to be in both. We'll be diving into your portfolio, your questions, your answers. It'll be 2 hours long. The first hour will be dedicated, just me walking you guys through the process. We'll be going into each phase for a full hour. And then the second hour, we'll be diving into your questions, and we'll make sure that we get all of them answered. This is not pre-recorded. It'll be me live helping you succeed. Now, I know what some of you are probably thinking by now. This sounds perfect, but it's probably way out of your price range, which is what a lot of people think about Legacy when they're first getting in. And that's totally normal. In fact, I would be worried if you guys were in here not thinking about the investment associated with this DeFi Formula Bootcamp. The reason why is because we are all investors at the end of the day. But the thing is, we've made this accessible on purpose, because if you can't afford to learn DeFi the right way, how will you ever build that 6-figure or even 7-figure DeFi portfolio that produces consistent cash flow? I want to be very, very clear, guys. There's a limited amount of time before the bull run is over. We will still be able to make money in a bear market, but it will be more consistent, yes, but also significantly lower returns. So why not stack our capital right now, build our bag up to something that is truly great, and then use that great amount of capital to produce consistent cash flow in the bear market and start to take profits. So the price of the DeFi Formula Bootcamp is a one-time $3,800. But that's not it, right? You can pay this upfront, or you can break it up into 12 monthly payments. And with the monthly payments, we have partnered with a company called Split, where you can pay 0 interest, 0 fees. So you can join today for just $317 and then pay $317 per month for the 12 months. Simple as that. Now I want to dive a little bit deeper, because we're all investors here at the end of the day. And I want to look at the return on investment of actually going forward with something like the DeFi Formula Bootcamp. On a $25,000 portfolio even, if you're generating a 50% portfolio APR, you are doing $1,000 per month in cash flow. You're outpacing the cost to join your first month. Simple as that. Even if you have a $12,500 portfolio, a $10,000 portfolio, you're outpacing the cost to join your first month. Now, I will say, we did say that this is specifically meant for investors with above $10,000 of capital. Now, I do want to be very, very clear though. This is not our DeFi legacy program. We do not provide one-on-one calls with with me and my team. We do not provide advanced bear market protection systems, which are DeFi stability roadmap. You will not have weekly group coaching sessions. You will not have unlimited direct message support. But this is the DeFi 101 before the masterclass. I know some of you guys are asking about what if there's an upgrade path to DeFi legacy or whatnot, and we'll dive into that in just a second. But this is the DeFi 101 before the masterclass. This is where you start. And if you need further support after this, you can dive into our legacy program. So you can join the bootcamp today for $3,800 or even $317 per month. Upgrade at any time this month, just simply pay the difference. Simple as that. Now, the bootcamp closes in 7 days. The next cohort is months away because, truth be told, we are only doing these in cohorts because we want to have maybe 20 to 30 people or so per cohort. And ultimately, we will host these probably a couple times per year. Now, I know what some of you guys are thinking right now. I have most of this information. Jake, you just gave me the playbook. You have about 80% or so. Let me just do this on your own, right? And that's a completely valid point. Again, that's what I did in DeFi. And then eventually I ended up losing $30,000 in Terra Luna, which I completely avoided had I gone through an actual process and had an actual system, had guidance, and had a mentor. So some of the problems you will face, again, this is just so if you do go at this alone, you can prepare. You're going to have trial and error for learning, right? You're going to have months of costly mistakes when the market moves, missing optimal entry points during the research phase. As I mentioned, time is money here. We only have so much time left in this bull market to the point where the quicker you can get in and the quicker you can start to accumulate more assets and produce income, the sooner you will be able to stack your bag and be prepared for the bear market. There's also going to be the divergence loss disasters. There's an average of 15% loss just from divergence that we measured on a $25,000 portfolio, which is $3,750 completely gone just to divergence loss. Again, this is if you do not have a systematic approach to minimize the risk. And when you're chasing a high APR, for those that do, you will fail for unsustainable yields that end up collapse. So eventually, what this will equate to is you'll have an average of 25% loss, which is around $6,250 on a $25,000 portfolio. And then when it comes down to market timing, again, bull market opportunities will slip away, and this opportunity cost could be above $10,000. Again, these are just examples based on data that we collected across people that joined our DeFi Legacy program before they joined what they are currently experiencing. But these are avoidable with the right guidance. And by being a part of the DeFi Formula Bootcamp, we provide what you can't get alone. The cost of not having a system is clearly over $10,000 in losses or missed opportunities. And the cost of the DeFi formula is just a single one-time investment of $3,800 or no interest payment, no credit pull payment of $317 per month. So if you guys are interested in joining the DeFi Formula Bootcamp, we're going to put the links in the chat right now, or you can go to defiformula.io/join. And if you guys do want to opt for the $317 per month option, you will just choose split it at checkout. So again, this is your option to choose your path to DeFi success. We're going to go ahead and pin the message in the chat right now. There we go. Now, guys, I do want to share just someone from DeFi Legacy and what they had to say. This is Robert. We talked about him yesterday, and essentially he put out a post in our Liquidity Syndicate community a couple days ago. He said, I've been here with Builder Wealth a couple months now. I'm starting to feel my sea legs, and thanks to who built the DeFi formula framework. He's a blue-collar dude from Southeast Ohio, and until recently, he only knew how to move money around the crypto landscape, but knew very, very little about the fundamentals. And his process initially looked like narrow his LP search, identify and VRM assets, simulate the position, buy the assets and configure the position, and then just immediately lose money to asset exposure or find the performance of the pool to be inadequate and just move on too quickly. And it was a constant flywheel of just chasing his tail and losing money until he implemented the DeFi formula framework, which gave him these results in just a couple of days. He said both LPs I'm in are performers and are churning out incredible fees. He's proud of it because it was the culmination of being patient, prepared, and informed, which is the essence of empowerment. And one thing I want you guys to pay very, very close attention to here is not just the profit loss, because truth be told, we could show you profit losses of $100,000, but we want to be realistic here. And this was in a short period of time. He is generating income, $683 of earnings, and he keeps $678 of that. He paid $5 to divergence loss, not over $6,000, $5 to divergence loss. On top of that, he has asset gain of roughly $830, which puts his overall profit loss at $1,500. And that is just profit compared to holding the market. Simple as that. That's an 8% ROI in the time span of a couple days. Now, again, this is just an example of what the DeFi formula can do. And we're going to go ahead and go into some questions and answers related to the DeFi formula and bootcamp. Craig said, lots of alpha today. Great job. Chung said, yes, I think this will be the bridge for the entry-level people towards professionally doing DeFi. Really appreciate that, Chung. Travis? Mary said, does the product offer the ability to provide another login to your assistant to manage and watch your investments? We can set that up. It's completely fine. Shoot me a message if you join, and then we'll get it set up. When does the next cohort begin? Yeah, great question. So in terms of cohorts, let's go to the face cam real quick. We're going to talk about kind of what times and everything like that. So we have this week, and this offer is going to be available for 1 week, as I mentioned. The first week is essentially going to be, grab the dates right here. The first session will start July 21st at 1 p.m. Eastern. So same time that this event started at on a Monday. And then Tuesday, same time. Wednesday, same time. Recordings will be available. If you need questions answered and you can't make one of the sessions for some reason, you can try to make the other session, or you can post the question right in the comments of the event, and we'll make sure to answer it. So yeah, it will be a full week. And if we could go to my screen, Esteban. There we go. So it'll be a full week, first week blueprint, and this is in Central Time because that's where we're based out of right now. But you could see 12 p.m., July 21st, Tuesday, at the same time on the 22nd, 23rd, 24th, 25th. So again, you guys have a week to join, week to decide if this is an opportunity to dive into. But the quicker you join, the quicker you're going to get instant access to the DeFi formula roadmap, and the sooner you'll be able to start diving into the modules, so that way you're prepared for these sessions. Now, let's answer some more questions. Is a 6-month program enough time to become competent? We believe so. So we did, we surveyed all of our legacy members before we even did this. We asked for feedback. We posted everything. We surveyed some members that were in our liquidity syndicate as well. We surveyed people that, that were thinking about DeFi legacy, but were kind of like on the fence and didn't really go with the DeFi legacy because they didn't seem like it was, they felt like it was a big jump. And all the data pointed this direction. And ultimately, 6 months is enough to be competent in DeFi. #alpha, I like it, Sanjay. Done other programs and strategies are sound, but it's implementation that gets glitchy and where I fail. I need an accountability buddy. Alice, that's exactly where we come into play. Show up to the calls live, go through the seminar, go through the recordings, and then also ask your questions, and we will dive directly into it. And then after that, should you need more implementation and one-on-one support, there's a complete upgrade path where you simply pay the difference to join our DeFi legacy coaching. Jared said, I would love to know more about the overall stats you guys are getting with the strategy, like win rate, average percent loss, average percent gain. So what we measure is assets accumulated. So basically what we're essentially doing when it comes down to asset accumulation is we're doing on average about an 80% APR right now, which is consistent. Again, a lot of our investors, they're not here to like adjust their ranges every single day, adjust their ranges multiple times per week. A lot of our investors are same time frame as me. Be in a position for 2 weeks, spend 2 to 3 hours per week managing it, and ultimately let it generate income. It's not passive, but it's somewhat close and it's completely liquid. On top of that, when it comes down to a divergence loss, we measure it on an overall portfolio level. We look at our clients' portfolios. If you take the earnings and you multiply that by 80%, that is their profit versus HODL. So basically, they are keeping 80% of their earnings, and that right there is asset accumulation. So what's the big difference between this bootcamp and legacy? Well, Shaw, if I were to put it in perspective, not everybody needs a Ferrari when learning how to drive. Not everybody needs to jump straight to the masterclass. DeFi Legacy, it comes with all of our systems. It comes with our formula, which is everything I just broke down yesterday and today. It comes with our stability system, which is tailored to the bear market and tailored to just remaining market neutral. We have a couple investors in there doing above 50% APR that are focusing on positions. Legacy has weekly group coaching for an entire year and is 1 year access instead of 6 months. Legacy also has one-on-one calls, unlimited direct message support, stuff like that. A lot of other minor things. Whereas when you join this bootcamp, what you are joining is a team of other investors that are in your same situation that you can connect with, but also you're joining to get access to our complete system step by step and have me walk you through every single step of the way on a live call with other people. So over here in the blueprint phase, how this is going to look is we are going to dive into the portfolio vision software. You're going to have access to that. I'm going to show you exactly what numbers to input and why you might input them. My goal is to teach you how to fish so you can feed yourself for a lifetime, not fish for you to the point where you can only feed yourself once. So we'll be diving into all of that in the blueprint phase, and then also all of your questions. Same exact thing goes for construct. Everything we just did on metrics, but in a more in-depth tone and doing it multiple times because we'll have 1 hour per each phase. And on top of that, live Q&As. Going into actually deploying your capital and showing you guys the process that we use for deployment, what we use for rebalancing, what we use for optimizations. All of that stuff will be covered. So again, think of this, the DeFi 101, getting started in DeFi, actually putting a strategy in place and being strategic when investing, but then ramping up over time. I'll take a couple more questions, guys, and then we are going to leave it for the rest of the session tomorrow, which we have a lot to cover tomorrow about post-optimization and tracking, which is arguably the most important lesson. So I'd highly recommend that you guys do show up to that one. Just like this one, there will be some stuff that we go over live that we will not be able to include in the recording because I was checking our SVPs and we actually have a lot of competitors that were on our mailing list joined up, from some of the top companies in the space. So. Correct, Samurai. This is fine for the true DeFi beginner. That's what this is meant for, right? DeFi Legacy is a big jump for somebody just getting started in DeFi. And if you've ever been on the phone with Ben or explored our DeFi Legacy program, we recommend that you go through our liquidity syndicate, right? That teaches you about crypto and whatnot, and like to try out some DeFi positions on your own before you dive into DeFi Legacy. But this right here is exactly what this was meant to do, bridge the gap, because we tell people try DeFi positions on their own, but they still don't know where to start. They're still holding crypto, but they don't know how to get into DeFi. So today we are creating the bridge, which is the DeFi form of the bootcamp. You go through this process, you go into the portfolio vision software, you build out your portfolio, and then you dive into metrics finance, and then you dive into other tools to start to track, optimize, rebalance, and whatnot. Can you confirm what alerts you receive once your pools go out of range, specifically a text is sent out? So I think you're referring to our Metrics Elite plan. Metrics Elite will give you price alerts on your email. And soon we will open up other avenues like Telegram. And then eventually, our goal is to move to a mobile system, but I can't make any promises there. But Telegram is on the roadmap. Awesome. Well, that wraps up the questions. I just want to say I really appreciate you guys tuning in. And regardless of if you guys do decide to get some support, so that way you can kind of avoid the ignorance tax, avoid making those costly mistakes, and avoid just having to quit this industry because the portfolio isn't performing up to your expectations, we're here for you. And we really hope that you enjoyed the content that we put out. We put a lot of hard work into this event, a lot of hard work into the content. A lot of it we give away for free. So yeah. You guys are way better than Crypto Labs research. Okay, I probably shouldn't have said that. Keep it up. Well, thank you for the compliment. We won't comment on our thoughts towards any other companies because we truly believe in just being in our own lane. Really, that's the builder wealth model, luminary assets model, metrics finance model. Be in our own lane. Really paved the way. If other companies want to copy us, we'll pivot. We'll be better. And simple as that. Awesome event. Thank you, Samurai. We'll see you guys later. Sweet.
Na Babilônia, pela primeira vez os judeus escutam a palavra anjo.
Ah, é?